Okay, so the question is, what do you guys see when you look at this image? The reason that I'm doing that is as we bid farewell to 2024 and welcome 2025, we contemplate how to navigate the investment world in this new year. The process does include research by highly respected thinkers, and I am fascinated by how highly educated and experienced investors um, forecasters, analysts have such different views of the market. Kind of like when you see this picture, the different views that each of you, when you see it. This phenomenon reminds us of the Warsh test, and the Warsh test is a psychological assessment tool where individuals are shown a series of ink blots and asked to describe what they see. This test is to uncover underlying thought disorders and to understand an individual's emotional functioning. Now, some are programmed to see negative, the black spaces, while others are positive, the white spaces. However, past trauma, political views, sales agendas, or other biases can certainly taint that perception. Kind of like what we're seeing with going into 2025. Now, the 25% climb by the S&P 500 faced minimal resistance last year. There was a 5% dip in April, followed by an 8% decline in August. However, this year felt like a cakewalk compared to 23 when we had a 20% market correction. It was a boring year for bonds, with the aggregate bond index returning only 1.3%. However, this was a positive return, which is something we've not seen a while in the bond index. Now, longer dated bonds ended with higher yields, causing the price of bonds to decline, almost offsetting the higher yields many cheered at the start of the year, at the beginning of 2024. U.S. equity valuations did surge in 2024, propelled by higher and less restrictive monetary policy, steady earnings and revenue growth, and the exuberance around the promise of artificial intelligence. Remember, we talked about AI several times last year. However, last year still had its challenges. Inflation crept further from the Fed's goal of 2%, with the CPI registering 2.7% year over year in November of 24, up from its most recent low of 2.4% year over year in September. Notably, super core inflation, which excludes food, energy, and other goods, housing, rents, rose by 4.3% year over year in November of 24 and up from 3.9% the same period in 23. This is the reason why they say inflation is better, inflation is lower, but why are we still paying more at the grocery stores or as much at the grocery store? And that's because, as I had mentioned early in 2024, inflation's here to stay for a while. It's going to take a while to actually correct the extreme inflation that we saw in 21 and 22. All of this makes forecasting 25 another significant challenge. The U.S. has run nearly 2 trillion budget deficits in each of the past 2 years. Half of all job growth in the past 2 years has been in government and healthcare jobs. Remember, we talked about this in third quarter, and growth in the money supply is trending higher. At the same time, the new Trump administration wants to cut spending by up to 2 trillion. Over how many years, we have no idea. They also want to push for an extension of the 2017 tax cuts and possibly cut other tax rates as well. Now, for some of you, looking at some tax changes would be a benefit, because I know the Trump administration is talking about removing the taxation of Social Security. So those of you that are having to pay taxes on your Social Security, this would be a win. However, I think at the end of the day, when you lose the standard deduction, I'm not sure if you're going to see the benefit right away. So we'll see what they do. As I mentioned, halfway through the year last year, the 2026 tax cuts is a concern. It's the 2017 tax cut, but they expire in 26. As I mentioned, I don't think the Trump administration is going to be able to accomplish anything in 2026. However, if they do, even if it's towards the end of the year, remember tax rules are retroactive, which means if they pass something in October of 26, it goes back to January 1st of 26. But I really think we're looking at 2027 before we see any significant changes to taxes, whether that's up or down. But remember, if they don't pass any legislation, we are looking at higher tax rates in 2026, as well as those standard deductions getting cut almost in half. So it's something that we're going to need to keep in mind when we're looking at income revenue in streams, because we obviously want to create as much income as we can from your portfolios to pay out to you. But the more we earn you, the more you're going to pay taxes on. However, as most of you know, I never apologize for paying taxes on money that I'm making you. In addition, one of the other things that we're going to have to look at in 2025 is tariffs. Whether or not the administration is able to pass the amount of tariffs that they're wanting to pass. Remember, tariffs are good for policy initiative, but they're not good for consumers, because this will do nothing to ease the inflation on about basically 80% of what consumers buy, because most of what we buy is imported. And those tariff costs are passed on to you as the consumer. So even if consumers do start to make that switch to made in the USA, this is going to increase demand and therefore increase the costs. So tariffs is great for policy initiative, but not necessarily good for consumers, especially in the short term. So that's something that we are going to have to keep in mind to see what that does. Spending. You guys know this is a hot topic for me. We as consumers have not even begun to slow down on what we are buying and how much we're spending. In total, consumers are estimated to have spent between $979 and $989 billion in November and December. This is an increase of 2.5% to 3.5% year over year. However, once again, my concern is credit card debt. How much of that spending is going on credit cards? Credit card debt is up 8.1%, a record high of $1.17 trillion as of November. And credit card balances have increased from 39 to 46%. This is where we have to keep an eye. The more we're putting on those credit cards, the closer that we're going to have to take those recession numbers into consideration. We have to stop spending somewhere. And I know that, for a lot of my clients, at least, we're not spending it necessarily on, things that we don't need. I mean, we're still taking vacations, and I love hearing about all of your guys' trips and where you're going and what you're doing. However, what we're seeing is the amount of money that people are spending on consumer discretionary, which does include vacations and trips and new cars. And the spending just has not slowed down. Consumer staples, that's not going to change, right? We're still going to have to buy bread and eggs and milk. And I know that there's a lot going on about the price of eggs. Remember, we talked about eggs at the end of 23 and the beginning of 24. However, the price of eggs then was due to bird flu. Now it is due to the lack of production, which is one of those things that, it is what it is, right? But some of the inflationary numbers that we're looking at, some of them are cyclical and some of them are based on what's going on in that particular sector. Housing prices. This is the one area that I'm a little surprised on, but I guess, 24 was an interesting year. We're see housing prices continue to grow as 2024 builds did not match the demand. So contractors are not building as many houses as what they had in 21 and 22. Now this is regardless of hurricanes and fire. So this was an issue before we had the back-to-back hurricanes that hit the the southeast, and now we have the fires that are affecting out west. So we're already still have a shortage of houses. And the hard thing is getting people that bought their houses back in the early 2000s, with extremely low interest rates, trying to encourage them to sell their houses and buy something else is going to be difficult. So, I mean, we're going to see a shortage of houses in some areas and a surplus of houses in other areas. But the unfortunate thing is there's still not enough houses to keep up with population growth. So I still think we're going to see housing prices continue to go up. So we don't see a housing bubble quite yet, but still something that we want to keep an eye on. Rate cuts, inflation. We don't expect inflation to fall. You know, remember, like I told you guys, where we're at is kind of where we're at for a while, because there's more than just the Fed cutting rates to fix the inflationary problems that we have. We expect CPI will be in the 2.5% to 3% range this year, and this means that the 10-year Treasury yield is going to struggle to fall below 4%. The numbers just aren't mathing. And so we are expecting one rate cut this year, probably later in the year. This is great for fixed rates. So if you're still buying those CDs or fixed annuities, rates are still holding very strong. But it's not great for those variable rates, which is affecting mortgages, home equity line of credits, etc. But this also indicates why financials are continuing to have strong returns. At the same time, China, the second largest GDP, is in trouble economically, while also making some trouble geopolitically. So we'll have to keep an eye on what's going on with China. Now, it seems like a lot of negative news, and it's not all negative news, but I'm going to be honest with you guys. There's still a lot of turmoil and volatility that's going to be in the markets this year. You know, this is the reason that I don't like looking at the markets day to day, but we do need to keep an eye on kind of what's going on. One thing that we do believe is that if the U.S. does get its fiscal house in order and at the same time projects power and not appeasement, the world will become a safer place. Whether or not this administration can do that for us, I don't know yet, but we're going to have to wait and see, just like every administration that we've had. In the Middle East, the October 7th massacre, which was absolutely horrific, was a turning point for Iran. While peace might not break out, I know they're talking about ceasefires, there is less chance of a wider war. So I think, you know, we're going to see maybe a little bit calming of what we have going on over there, but it still is going to affect oil prices and other things. So still something to keep an eye on. Trump's victory is affecting politics in many other countries. Just look at Canada, France, Germany, the UK. Doesn't matter if you like Trump or not. A lot of the other countries are looking to see what he is or is not going to do. And so it's something that we have to keep an eye on when it comes to international and emerging markets. While there are many positive things happening, this new world order is still uncertain. Less regulation is great for growth, but reduced deficit or short-term headwind. In the long run, just like under Reagan, smaller, less intrusive government policies are a massive positive. It's just, can we get it done with this administration, and can it be maintained under whoever is going to replace this administration? Like I said, I always want to leave at least with a positive. We do live in the greatest country in the world with the most innovative technological companies, freedom, a strong military. While there are still many problems, it is a special time to be alive and a great time to be in America. The economic gap between the U.S. and the rest of the world is continuing to widen, and it will certainly not be a straight line up in 25. And there will be struggles, especially as politicians are going to make plenty of noise. But I really, like I said, most of you know that I like looking at fourth quarter earnings. So, you know, once we get through this earnings season that we have going on currently and over the next few weeks, I'll be excited to give you guys a recap at the end of first quarter of what happened in the markets and kind of what we expect going forward based on where we're at with those fourth quarter earnings. Lot of information. I went over it quickly because you guys know I like to be able to take your time seriously and keep things efficient. I am going to turn the recording off so that you guys can ask questions.